All right, good morning, everybody. Welcome. This webinar is brought to you by White Wave Trading Strategies. Today we have Stan Yabroff from CQG, and he is going to speak to us about the Imoku cloud and how to use it. And I'm just going to turn this over to Stan.
Can you give me control of the mouse?
And that I can do.
And hit the record button.
We've hit the record button. Let's see. Stan has remote control.
Okay. Okay. Good morning. What we want to talk about today is, and this is a chart that I made up for the cloud, the Imoku cloud, Ichimoku for the longer name, and that there's even a longer name. And it's made up of five indicators, and we're going to just define them first individually, and see how they fit. And each of the indicators, the trading indicators, I've marked, and I'll go over my indicators, and then I've created a study which adds them up and tells you when all of them are either bullish or bearish. And so we'll start by defining the five indicators. The first one is the purple line, and its official name is Tenkan-sen. And what it is, and this is the key here, it's the midpoint of the last 9 bars. Judd calls it momentum because it's the fastest responding of the moving averages, of the averages that are here. The second one, and one of the more important indicators on the Imoku system, Kenjin-sen, is again the highest high, the lowest low, divided by 2, which makes it the midpoint for the last 26 bars. Now, this, because it's a longer indicator, it shows you the midpoint of the last basically month. Now, one thing to understand about these calculations is that they look at the bars. They have no idea what the bars are. So obviously it will work on any time frame and really any chart type, because it just knows. It doesn't know whether this is a weekly chart, a daily chart, or a 5-minute chart. It just knows there's bars. The third line is the blue line that makes up the part of the cloud. And that one is called Senkau span, and Kumo, which is where it comes from. This whole thing is the cloud itself. So this blue line is the midpoint between these two, displayed 26 bars forward. So what you're seeing on the blue line here would have represented where this was 26 bars ago. So it's being pushed forward. The longest line, and therefore one of the more important lines, especially in the way that these charts are interpreted in the trading room, this is the midpoint of the last 52 bars displayed 26 bars forward. And again, the reason that is done is because, as we can see here, the cloud is displayed forward from where the market's trading right now. Now, the last of the lines, just for definition, is called Chikao, or the lagger. And what it really is a line chart of the closes displayed 26 bars back. And one of the reasons that it's done 26 bars back is it gives you a easy way of being able, when I go up here, I'm not looking at the highest high. Well, in this case I am because it closed on a high, but I'm looking at the highest close. Now that brings up something I want to bring up as well, because I don't know about other systems, but just to show you in CQG, and this would make a definite difference in what you're looking at here, is we have the ability to make the line for the close, either the close or the settlement. And we can calculate net change on either off the close or the settlement. The reason I bring that up is if you're looking at crude oil, for example, it settles at, if I go to Eastern Standard, I apologize, about 1:30 Central, and it trades till 4 o'clock. So if you're looking at settlement, you're looking at what it was doing at that point in time, not what it was doing at 5 o'clock. Gold falls into that same category. Now the stock market now settles at 3 o'clock Central, the same time that the stock market settles, but we still trade till 5, though we take a break from, again, that would be 4. We take a break from 3:15 to 3:30, and then we trade again for a half an hour. So there is a difference, and there will be a difference depending on whether you're looking at the settlement or you're looking at the last trade of the day.
It's the difference between just what Stan is showing you is the difference between what the US session only and the all session is.
Yes, oh, that's correct. When Judd puts up the SP, we're looking at the old pit session only. And in the case of the SP, the database goes back further, which is why Judd looks at it. Plus the fact is it shows the gaps between when the stock market wasn't trading, but the futures was. We can also go back in EP, and we could also pick out just the primary session, but the database doesn't go back as far because it didn't trade all the way back. So, but the big difference here is going to be the settlement versus the close will make a difference. So the idea of this is that there are a multitude of indicators. Now, again, we'll send this out I can write this up as far as these indicators, but if you don't have CQG, you won't get them because I program these all. The arrowhead or the triangle indicates the crossing of the purple line over the green line, Imoku 1 over Imoku 2. The arrow itself indicates coming out, exiting the cloud. So once you get comfortable with these, I take everything off except the dots. And that's only because it's showing you something that's not easily visible. The square indicates that the cloud changed colors 26 bars in advance. Just to show you what that would look like here is because here you have, oh, that's not it. I thought I took these off. These, by the way, just for your information, it's a little, these are the ORH days or bars being marked as they occur anytime on the chart, which would, draw your attention to them. There's your lower and the green is the higher. But going back on the blue and the dark red squares, if the cloud changes color off the screen, then you're getting notified here. We're going to go down here and I'll show you this at the bottom because that's also why I put the little thumbs up things down here so I could see exactly what color it was in the future. Now these all indicate trades depending on how you're interpreting or how you're using the cloud system. So every time you see one of these, it indicates that you're looking at a trade. The diamond indicates that the market closed above or below the green line, again called the equilibrium, and it would show you when you are crossing the equilibrium, again being a fairly major indicator within the cloud system. The little dots on the top of each one is showing you where the lagger was 26 bars back, and it's just showing you on the current bar whether it's above or below the current price action at that point. So when you see the blue dots on top, it means that the brown line is above the current trading as far as close is concerned. Because here you can see it went down and it went below the highs, but it didn't close down there. Maybe it did once, because I do see a red dot right there. And so it indicates, so you don't have to look back. So those are the key indicators. What I've done is I've created a study that nets out all of the pluses and minuses and alerts you to what would be considered the ideal trade when they're all green or all red. And it also shows you in the timing of this how long it's been in that situation. Here we had 2 solid months where every single indication was bullish. And then here you can see where it was marked. The first thing that happened, well, in this case, the first thing you had was a ORL down, followed by the changing or the crossing of the 2 moving average, or the 2 averages. And then you started to see all of these change. But you'll notice that it never broke into the cloud. It never got down to the cloud. So these are obviously levels of support and resistance. So if we start to go through some of these on an individual basis, if we look at the brown line, again, we're looking at the midpoint of the last 9 periods. And one of the things that makes this kind of unique, and it goes for all of these, we're going to put a lot of emphasis on it on the red line that makes up the cloud, and that is when it goes flat. Because when those lines go flat, and that would be the purple line, the green line, or the blue or red line that make up the cloud, it means that the trading range hasn't changed over whatever period that's long. So that's telling you that there is a stability in the market. Now, it could be a mid-course correction. It could be that we're now entering an area of sideways trading. So we're always aware of here's one here where you can see that this.
Peter, wait a second. Peter, do you want to ask a question, or you?
Yeah, I just want to ask a question.
Go ahead.
Tell me what you think about this statement. Okay, when the cloud starts to become, I mean, when a market is just trading sideways, you don't really get signals on anything. But when it begins to trend, one thing that tells you it's trending, and really pay attention, is that the cloud becomes, it bounces off support in the cloud, support or resistance in the cloud. And that's kind of a tell you are in a trend now.
Absolutely.
I don't know. I'm trying to. Okay.
Now, one thing that we're going to talk about.
Stan, let me interject one thing. So the way I use it visually, okay, is if you go back here, anytime it comes to the top of the cloud, that's going to be initially resistance. All right. So if you can see in here, as it comes up to the bottom of the cloud, you don't want to buy that strength initially, but as it gets into the cloud and starts holding and then starts coming back up, it wants to go to the other end of the cloud. Now over here where the cloud gets really skinny and it has this breakout, and you had an ORH signal here, which is telling you that you're probably into the market might have bottomed. Now you're looking for the trend to try to reverse off of that ORH at the bottom of a move. As it breaks out through the cloud and then comes back and holds again here with another ORH, basically, or didn't quite give it to you. But this shows you that the trend is now going the other way, and you can see it by the green indicators here showing you that. Then it gets into this big, long, sustained uptrend line. Now, it makes it harder to get, this was the breakout. Now you're in this trend pattern. And when it gets back to the top of the cloud, however long it takes to get back to the cloud, that's when you can get on the trend again. Because the first time down to the top of the cloud, that's going to be support.
Yeah.
Now-
So in that case too, what do you think about this? It tells me the fact that the cloud still was support means that trend isn't rolling over. That's just a correction in the trend.
Right.
Let me show you something. And actually, the ultimate trend, the ultimate support of the trend is the bottom of the cloud. And we'll go through all these things, maybe more than one session.
Yeah, and
But-
that was beautiful in the S&Ps on the low this year.
Never took out the bottom of the cloud on a closing basis, even close, on the S&P during the pandemic drop.
Go to a quarterly, Stan.
Well, in a daily, did it take it out or not?
No,
Oh yeah, but the monthly was the first one that it didn't take out.
But yeah, look at the quarterly doesn't show up as much, but the monthly definitely does.
Yeah, and that was important, especially for people that may be managing, large portfolios. And by the way, maybe it's a little bit easier. Certainly, the Japanese think so. So if I switch this to a candlestick where you can see the opens and the closes, you can see that this was a probe, but the probe, markets moved down to find buyers, and this clearly found buyers in the cloud. And it brought it right back up, and it never got even really that close to closing in the cloud, let alone the bottom. Now, that doesn't mean that this probe that went through the cloud wouldn't have had a lot of people liquidating their positions or changing their allocations or whatever how you're reacting to the pandemic on a broad base. And again, as we realize, these are monthly, so we had to wait the month end to see where they were going to close. It did probe below the cloud, but didn't hold it at all.
Put up SPH.
You mean the SP?
Yeah.
Okay.
See, and now I think you can go to a quarterly on that, because that's a U.S. session, and that goes back to 1982. All right, it's pretty much the same look. I just wanted to check that out.
Let me just switch this a little. I don't know how, but we lost the thing at the bottom. Oh no, that's on mine. Let me just get rid of okay. So, and by the way, you have to make sure you're using continuation. Now these longer ones on CQG are automatically continuation. I use the active. Judd likes to go all the way to the end. We can also set it up so it can go, it can use expiration, but we can set the number of bars before expiration that it actually rolls. So you can get a median between the active. And remember, with the active on the stock indices, the exchange tells us when to roll. So that means everybody is going to be rolling on the same day. And that's the kind of let's call it noise that Judd tries to get rid of by not following the active continuation on the days that it occurs. So just to explain that along as we go. So let's take a look at these some of the things. One, we talked about the flattening, obviously, and let's go back to the ZME because I think that's what I had up. And let's go to ACD. Let's try comma ACD. Come on.
Just go back to a daily, click back through the history to a daily and then type it in. Sometimes that'll work.
Okay, comma D. Okay. And then let me do comma ACD. Whoops, I comma them.
There you go.
There we go. Okay. So the things that we're looking for here are the angle that this is moving up on. And that's important. The steeper the angle, obviously, the stronger the trend. But, and again, of all of these indicators, the purple line is also going to give you the first indication of a trend change. So as you see this going up, you can see this level off. It still goes up, but the angle's not nearly as strong as it was, leading to a turn to the downside. Now, again, this acts like a rubber band. So it's being pulled back first to the equilibrium, went through the equilibrium, was pulled to the top of the cloud. Now, the ultimate support is the bottom of the cloud, which again we'll discuss later, but the thickness of the cloud indicates that there's strong support there. I think one of the advantages of the cloud is it focuses the support and resistance as an area, not as a point. And a lot of people will put a line on and they'll say, well, this is the support level. Well, not all of the buying comes in at the same level. And this kind of indicates that there's a lot of support down there, and it would have a pretty good move, as we saw during the pandemic on EP, to get through the cloud, but even then it couldn't hold it. It immediately went back up again on the monthly level. You can see, of course, that soybean meal has been a terrifically strong market. So the sideways, the flattening, we do want to make sure that as far as trading, that the purple line is above the green line. We'd like them to be fairly close to each other and fairly close to the bars themselves. A lot of it comes back to, if it gets too far away, then your indicator is that, the move it's not necessarily a good place to get into the trade. So we're looking at all of these indicators as we look through just the first two. So then when we focus on the second one, which is the same calculation but for 26 bars, this becomes, and this, by the way, I was teaching in the financial lab at Lehigh University, and we had a lot of Asian students there. They're the ones that told me that the Kenjun Sen's translation was basically equilibrium. And it made so much sense from the philosophy of it, but it actually means equilibrium. So and like this, it acts as a rubber band for those that are using shorter time frames, and you might be doing day trading, is that it tends to be pulled toward the equilibrium. And here it was so strong, it didn't get pulled very close. But now here was a flat area. And again, that's indicating, and we can see it here, that we were taking a mid-course correction where we were not quite as strong going up. So the high and the low didn't change. Therefore, the midpoint of the high or the low didn't change. One of the real advantages of looking at the cloud lines compared to a straight moving average is it doesn't reflect when the market's going sideways. When you see over here, now this is the blue one, which is not as strong as the red. When you have a flat line like that, that still shows a more of a sideways motion. When you see it in the red, you're looking at a long 52 bar high low, and we haven't had a high or a low in 52 bars. That's 52 days, 52 weeks, 52 months. So the flat surfaces are a major feature of looking at the cloud system, because we are looking at midpoints of ranges. We're not looking at closes. So the basic idea is the same as the purple, other than the fact that it's a longer time period. So the market tends to move back and forth as compared to the equilibrium, which is what makes it important. But it's also important when it breaks the equilibrium, because now you do have a change in the way we look at the bar. And then, of course, when it gets back above again, and then we reinstate our long. Now, some of the people who trade, remember that for the longest time, the clouds were used by currency traders in Japan, and still do. I have a friend who is an analyst at UBS in London, Jason Pearl, who happens to also have written a book on the DeMark indicators. And he's traveled the Pacific Rim a lot. And the one thing he said he noticed about the cloud is nobody changes the parameters. Now, there has been some discussion that when we went from 6 days of trading down to 5 in some of these areas, some of the people played with the numbers. But the one thing he noticed was that the people he looked at did not. They kept the parameters as they are in CQG and as they are in any writing or books that you might read on it.
So you just want to use the default indicators that come with whatever system you're looking at.
Yeah, especially on these. And that's what and again, that's what everybody tends to do. Here, by the way, you'll notice that it went flat. And here you could see where the range started to take off again. And that's because we made a new high. The range got bigger, and we started to see the move back up in the game. Again, this is very, very important that the horizontal part shows a trendless market, or a breather in a trend that you would be able to see.
All right, Justin's got a question here, Stan, I think.
Go ahead.
Quick question, Stan. So Pearl's observation of the parameters being basically unchanged. My question is, any comment on whether the time frames are FX traders using one particular time frame over another?
They use a 240-minute time frame.
That's a big one for currencies. That means that every continent has its own bar. So that's the reason they came up with the 240, is it they can kind of see where the action is taking place by what bar showed the movement. I did want to point out one other thing. If you get CQG, for example, and you put this on for the first time, it's going to be red going up and blue going down. So the first thing I do is change the colors. And the reason being is, in Japan, red is bullish, blue-green is bearish. and that doesn't fit our the context we look. So the first thing I do is change the colors. I reverse them. And I reverse the colors on the blue and the red line, the red line being the longest view, and it's on the top, or the blue line here, I'm sorry. It's on the top of the down cloud, it's on the bottom of the up cloud. And this is the
So the
52.
the
We're
beauty
looking
of
for
this
the
is whatever
size.
time frame you're looking at, you can throw up any instrument in the world, take one quick look at it, and you know whether it's in an uptrend or it's in a downtrend, if you have any trade location at all in it, or if it's just been in a move like the meal, and it's going to take some time before it comes back to its averages again.
And to go along with that, if you're looking at this, especially in intraday trading, then the first thing you want to do is make sure that the trend that you see in the daily, the weekly, are in the same direction. So you may see a nice sell, but if you're looking for a lower risk trade, then you want to be trading in the direction of the trend in the higher time frames, which again is why in the trading room you're constantly looking at multiple time frames. And again, this is also why this particular technical indicator fits well into that kind of an analysis. They emphasize daily, weekly, monthlies, but it'll work in any time frame. As an example, I can put in a.
Well, this is what's great. Excuse me, Stan. This is what's great about CQG. Okay, that you can't get anywhere else. Look, I can go up here, and I can go. There's a 10-minute, 15, 30 hourly. I can go to a 240-minute chart. Okay, but the beauty of this, and you can see here how this broke out on a 240-minute chart and just took off, came back. You see the same thing in the different time frames. Now, the beauty of this is that I can right click on history and I can, well, hold on. Oh, because I have a daily up. Hold on, let me go to a active daily. I can right click on the history and go out and look at life of contract. So you hear me talk in the room all the time about, do your progressions. Get out of a 5-minute chart, go to a longer time frame chart, and then with CQG you can quickly click out to an annual and see if there's a disparity in the movement. If the short-term movements are lining up with the longer-term trends.
You're also getting clear indicators on this, and this is why one of the advantages of being back is the fact that you can see where they rotated. And you're not getting, and again, it's a little more conservative because you're not getting the low of the candlestick, but you're getting the close of the candlesticks. And so this is the highest close we've had in meal, and we're down from that point. But you can also see that we had we had a level here, and I'm not going to just put them all in, but you can start to see, and you'll see that this level here captures this whole area, these two. And again, you can see them over here. Now, a lot of times I'll put on a bar chart, and I'll color it with say Heikin-Ashi coloring, because you'll notice that if I go here and I go to a Heikin-Ashi, which has the smoothing color, but what you see is the close on the Heikin-Ashi isn't the close, it's the open high-low close divided by 3, or high-low close divided by 3. And so there's an algorithm there, but and you'll see the levels are slightly different. So if I put up a bar chart and I put up the green and red coloring on it, I can get the advantage of the smoothing, but I can see the actual price action rather than the smoothing action. So, but you can also use it on Renko, and I'm focusing on the Japanese chart types because it's their study. And then you put up the cloud on it. This one obviously doesn't have all of my color. I muted these colors a lot. I hope I can get back to it. But you can see how it works on any kind of chart type. And I've never really looked at this, but even going to here's a 25/3. This is soybeans. But once it populates, I can even put a cloud on here, and as it fills in and I get the cloud. And again, I have not looked at these and studied them. In this case, I'm not getting enough data.
There. Let's just put something else up that should work. Let's
Yeah,
just
currency
put up the euro currency.
Yeah.
Oh, that I like, Stan. And I even put that up on my point and figures.
And because of the nature of it, notice you have the flat area here, indicating that it's trendless in this period.
Oh, I like that a lot.
See it take off here.
Yeah.
So the philosophy works the same. And let me go back over here for a second. I want to do something. Okay, I'm just going to go in here and make this my default because clearly when I went to the other one, this wasn't set as a default. I like the muted colors because I like to see what's happening behind the cloud.
Okay.
The other clouds are just they cover up everything. So basically going back here, this is a 240 day. By the way,
That's a 240 minute. That's like a half day S&P.
yeah. And again, from the currency point of view, they do that because of the fact that basically that means every bar, one's Europe, one's the US, one's Asia. I say two in Asia because it's so big, the area. And they can see where the action is taking place. Even in places like crude oil, the years I spent working on the floor in New York, you know, there were times when the crude oil's complete movement occurred in Europe. Then we opened up and we did nothing all day. Then at night, the Europeans moved the market. We opened up, we did nothing. That's a lot more visible when you're using a 240-minute chart, which is why the currency people in particular did that. We can go back over here and actually let's go here because I like this is my coloring. It's just easy on the eyes. And again, you're looking at the bottom. So if we go back to just the comma ADC, and we'll go through some of the other things. Again, we have the equilibrium, and this gives you the crossing of the green line, gives you a good trade indicator by itself, and also by looking at the purple line and the green line as an oscillator. Again, here's where the market crossed, but here's where the two indicators crossed, and here's where they would cross down. And again, it can be used that way. We're going to talk about the lagger now, and I put this in because the lagger can be used as a trading indicator, but what it is more than anything else is a check, a confirmation. If you get a buying indicator here to buy, you want to know where the price was compared to 26 bars back. That's why I put the little dots on, because I don't want to have to sit there and count 26 bars back to see if the price was above or below the brown line. So I put the little dots on. It was interesting. It was quite a challenge to put these things and get them to display on the correct bar, because some are back, some are forward. So when this crossed, if you have a green dot at the top, that's one big confirmation that this is a good trade, because it was trading the line chart 26 bars back was above where the market was trading. So that becomes a major confirmation. If you trade crossing the green line, again, we have green dots. You have your confirmation. Here you have some red trading indicators, but notice the dots are still green. Weak trade. It's not nearly as strong as a trade. When we get into the trading section, which may not even be today, one of the big things we're going to also look at is whether, when you get a buy indicator, are these other price actions and these other indicators below or above the cloud. We've kind of haven't got to that part of the cloud yet, but these are also all above the cloud. So that's another confirmation. If you're above the cloud and you're getting buy indicators, it's like buying with the trend. If you get the confirmation with the lagger as well, now you're approaching this area down here where you get three dots.
Here, let's just go back here, Stan. Look how the cloud keeps you out of trouble. Right here. Let me have this a second. You see how we're coming up to it's a falling cloud, right? You come up to it, you don't want to chase that strength. The next bar over stops at the cloud and rejects first. So not only does the cloud tell you what you can do, it tells you what not to do. And here it's telling you that you want to be very patient about buying strength, because this is a really steep part on the cloud. So you're better off just being patient and wait, or you might want to take some profit here and see what it does. Because you're not getting a clear breakout. When the cloud's flatter and then you get a breakout, you get a better trade.
And this is exactly what we talked about, the magnet. Notice this is all flat. That means in the last 52 bars, we did not see a new high or a new low. Notice when that's the situation and you buy here, you always have the risk that it's going to come back to the flat line. And it did twice on this one. It broke out, came back to the flat line there, went back up again, came back to the flat line again, then got the momentum to go up. Meanwhile, you noticed how it crossed the cloud when it was narrow. By the time we got down here, this cloud was no longer narrow. There was a lot of support underneath it. And again, it came to the magnet, but the ultimate support is still the bottom of the cloud. And that's why when you're moving up in a broader sense, this is your trailing stop.
Okay, so where's the buy stop in May there?
Well, again, and actually on this buy here, to start off, it depends on what you're, again, this is all personal things, but the ultimate buy stop would be the bottom of the cloud.
The sell stop.
A sell stop. And then
when the green line crossed the flat line, was that a buy stop?
Well, it's certainly again, that would be a very conservative buy stop, but it absolutely does, but it might in this case be a better entry point where you're waiting to see whether this is a magnet. Just think of this as a magnet, and it pulls the data back here. And so this area here would be a very good indicator. So
and what you're seeing right there, Peter?
Yeah.
You're seeing the grains.
This is S&P.
Wait a second. They're doing a dance here before the May expiration of the grain contracts.
This is S&P.
No, that's S&P. Okay, sorry.
We can put in.
Well, I think it's interesting because that was a very weird action in the whole market that it V bottomed, and there were so many bad stories going around about the economy and everything, and you know, and I think a lot of money was right there is a very critical point in May, because you could see a rebound rally, but then you wanted to see if that was going to stick and continue. So this is really critical moment where big money could be reallocated in the market.
So if you're short, if you were short in April, where you stopped out based on this chart?
Well, the problem that you have is it depends on your risk parameters. I mean, when you start to look at this, you can start to see down here, number one, you were never all red, but you started to see that you got all the way down to the last one. The little red dots tell you that this was still giving you a short signal, the lagger. Probably the best, the first thing you're going to do is the market was being held by the purple line at this point.
That's actually simpler than that. Was it higher or lower on the year?
Well, yeah, I mean, we're going to other time frames for correct, and that's
You need to go out and look at a yearly or a quarterly, and when you see it on a yearly, Jesse, it becomes very obvious that once it held back up above higher on the year, after it blew through it, got all the stops, came back up. Here, let me just go. Hold on a second. Just let me go to a yearly so you can see what I'm talking about. This is why you have to look at your time frames. Okay, here you can see it as semi-annual, all right? It got the sell stops below 27.75 on the semi. The yearly, the sell stops were 24.38.5. This is the point of control for the whole market, okay? Now I'm going to put this horizontal line in. Once it sustained back above 24.38, there was no short, period. This kind of stuff never changes, ever changes. Whether you're looking at a 5-minute, an hourly, a 240, a daily, a monthly, a yearly, a quarterly, semi-annual, or annual chart. That's always going to be the point of control. And once it gets back above there, that's the end of it. We just saw this 2 days ago in Alibaba, where it got the ORL quarterly stops below 215, and now it's $30 higher. Okay, now let's go back to what you were looking at. And what chart were we looking at there, Stan?
Yeah, this is the EP.
Right, but what time frame was it?
I think it was on daily.
Okay, so
here's your flat line there. Your flat blue line goes all the way over here. But
yeah, but so 24.38.
Oh,
once it went back above 24.38 in March, that was the end of the down. There was no more.
This looks a little different. I'm not sure what we were looking at.
Yeah, either.
Let me hit the enter.
I'm not sure what we were looking at either, but
oh, here.
We're looking at it back here.
Yeah.
So here you can see the line changed a little bit, but look at how bullish this is already. Here, there you go. So here's your point of control right there. Once it got back above 24.38 and stayed above 24.38, that's the end of it. There is no more down. Okay.
If we move it up a little bit, you can see that these closes here also give you a very clear bottom where remember, this is just a line chart, 26 displayed 26 bars back. And you can see here where it gave you that reversal that was very visible here. And once we took out these levels here, again, it's the same thing. That became your breakout. And what's obviously common in markets is they test the breakout points. They held, they moved up, they came back and tested another major support level, and that was the flat blue line. And then, you know, and then we could see here that the cloud turned up, and that was 1 bar after we tested that. And that was giving you another indicator that this was now starting to move up, because the distance between the purple and the green and the high-low midpoint going back 26 bars crossed. And that gave you the blue cloud. And so all of these are all bullish indicators at this level. And then when you see it go green down here, I don't know what happened to my little thumbs up and thumbs down, but which would give you the fact that the cloud was blue this entire way out.
So in other words, Jesse, you know, there is no short. All right. You can trade, you can contra trend trade, but you're back into a bull on a yearly chart. So that's why pretty much this is the biggest mistake that 99% of traders make. And this is the problem with all other charting platforms, that CQG is basically the only one that allows you spread bars, point figures, and the ability to go look at long-term historical data to see what's really going on. Because everybody gets lost in the myopia of a 5-minute, a 10-minute, an hourly, a half day, a daily chart, and they're missing what's going on. And that's really important as a trader. You know, every time that somebody asks me to look at something, you know, I click that historical button all the way out to see if everything lines up, because you're always going to get, you can always see something differently in the longer time frames that are probably going to tell you something about the condition of the market.
So what I'm understanding is, let's go back to that 2438 level. That was critical. Okay, so Judge, you said the 2438 was critical if we recaptured it. So we can see here that we've recaptured that in terms of the price action is developing above the 9 bar back midpoint.
When we tested it.
Yeah, when we came back and retested it.
Yeah,
Even
so
Jeff
right
in the room said that day, he said, I guess we're supposed to be buying them here. And that was a stone cold low. We rallied 400 points in a straight line off of that.
So that right there is really the earliest indicator that we weren't going down anymore.
Right. And the big thing when you're looking at these charts, you know that markets want to go and screw the most amount of people, right? And they're looking for stop runs off these time frames. That's what algos do. And I had guys calling me from all over. Is the bottom all through here? Is the bottom in yet? Is the bottom in yet? Is the bottom in yet? And I kept telling them, no, we have to go through the stops. We're going to go get the stops below unchanged on the year before you can even consider that there's a bottom. The first time down, we came down to that area, we rallied, I don't know, 160 points at night. And then it took 2 more sessions before the US actually came down and elected those stops during the US session. It tells you how the market's moving from A to B.
Now conversely, in early March, when we broke through to the downside of the cloud, early March, over to the left of, yes. So right there, when we broke through the cloud and then we came back to the midpoint on the 9, right there where those red pyramid is, right there, what is that? That would be price action bearish, obviously. Is that correct?
So
Yeah,
that's a short-term cross here. But it also, this little square tells you that the cloud, so this turned bearish, this turned bearish, the red dots are bearish. Now you're approaching, you don't have all of them, but you have all but one.
all right. Well,
And so you're looking for
let me have this for 1 second.
a combination.
Okay, go ahead, Stan. You
Yeah.
see that horizontal line, Jesse?
Yeah.
You see where it touches at 3,400? That high is 3397 and a half.
Yeah.
3,400 was a swing count from 2018.
Okay.
Okay, you got an ORL day in the S&Ps. You had an ORL day in the SPU bonds, NASDAQ bonds, okay, Dow bonds, and you had weekly ORLs. So not only did you have it here on an ORL on the top at a particular big time target number, but you're getting cloud confirmation that it's real. So you had risk spread confirmation, you had technical confirmation, and the cloud showing you the exact same thing, only in full color.
And the spread bars went negative before
The same day, and then they started turning. So when all those indicators start happening at the same time, you get a bigger signal.
And we can put up, let's just go over here. And we can put in EP divided by USA. And you can see that the interpretation is there on the spread bar. It's exactly the same way it was on the individual EP. And you know, this is why I also throw on the you know, the ORL days, because there was one right back there as it went through the cloud.
Yeah, look at it right before the diamond, and then you've got your down confirmation. Now, anytime a market lines up and turns, okay, all this stuff's going to line up and do it at the same time.
And but again, you don't always have to wait for everyone to turn, because you'll notice that it didn't really turn red until we already got down here.
Right.
But everything was here before that. So they are different indicators. But again, you'll notice that in this case, what was interesting was you got the break just before this went flat.
And you
again,
also had a gap lower, and that gap wasn't filled for 6 months in most markets.
So it gives you a picture. And when you're looking at many symbols as you look at with the equities and the commodities and the spreads, you look at this, you immediately have a context to the big picture. And again, with the buttons that we were showing you, you can easily go to a weekly, and you can see whether you're getting confirmation in the last one. And if you're looking at the daily charts, you really want to see what the weekly and the monthly is. You know, the idea of a multiple time frame is the longest time frame gives you the trend, the medium time frame gives you the trade, and the shorter time frame gives you entry and exit. And basically that works here too. And that is that if you don't get confirmation in the higher time frame, it's not that it's a bad trade, it's a riskier trade. And again, here's another great example on the spread. Look at this. It broke out here, went all the way out here. And what did it test? The flat line. Brought it right back to the flat line, also to the equilibrium, which was at the same place. So this is again showing
you know what night that is right there that he's pointing to? That's the election night.
So
That was the election night.
Yeah.
That was Trump's election night, where we went limit down in the S&Ps. NASDAQ, the bonds were 3 points higher, the gold was higher, everything hit matrix levels, and the entire board flipped.
And I didn't know that, but it's an obvious point on the cloud. It did exactly what it should have done based on the philosophy of the cloud traders. Like textbook.
All right, take care.
okay, so Stan, basically we're looking at a chart that's depicting the relationship between 9-bar, 26-bar, and 52-bar equilibrium midpoint.
Midpoints, yeah.
Okay.
Yeah, those are those 3 lines. And that's what makes the value of the blue line here is the fact that it's 52. We're looking at a weekly chart here. That means it's a year. That means for this whole period, the ratio between the S&P and the bond didn't make a new high or a new low in this period. So it's a flat area. It's an area. It's a trendless area. We broke out of the trend, came back, tested the top of the trendless area, and then anchored the trade up from there. These become confirmation of the fact that now you see we crossed here in the cloud. That would be not the strongest trade, but the neutral trade. Because it wasn't until it broke out of the cloud that, and well, in a way, the price was here, but the cross was in the cloud, so it's not as powerful as if the cloud was outside or below. The price action is important in its relationship to the cloud. So in the area that we're trading in the cloud, it's neutral. So if you're bullish and you get the cross below, and the market's below the cloud, it's the weakest of the uptrend because it could easily be stopped by the cloud, the bottom of the cloud, the top of the cloud. If it's in the cloud, if the ultimate resistance is the top of the cloud, the ultimate support is the bottom of the cloud. As long as you're in it, you're really saying that if anything changes, anything fundamental, any bias to the market, you could easily be wrong. But at the other part with a narrow cloud, it gives you a good stop area. If you were to get in here and you know that the bottom of the cloud or the top of the cloud is your stop, then that becomes a really good area to be able to have a low risk trade. Once it breaks out, again, the ultimate thing would be to trail with the red line and then the blue, the bottom of the cloud. For me, the longer it stays in there, the more I might want to pull, if I got a lot of profit, I might go from the bottom of the cloud to the green line. If I stayed above the purple line for a long time and I wanted a tight stop, again, it depends on your risk. It depends on the shortness or the perspective of your trade. This would be your quickest exit. And again, you could say 10 ticks below it. And remember, you're looking at closes here, so you would have the end of the day. And you could go there. You could also use the green line. And again, you can see because we're marking it. When you got a red diamond, you actually closed below the green line. You would have been out here. But again, you could have been in, but ultimately you would have been in again here, which is when this all turned green again. So if you wanted to play where any penetration at all on a closing basis got you out, you have a level here.
Yeah, and
here's a
day
little... and use the weekly green line as your exit, but use the day trade, for your, for a different.
Leave it there for a second, Stan. I want to show these guys something. You see this ORH on the weekly? The next week kind of opened up and it brought you just back to the back below the midpoint of this bar. The next week where you got the diamond, it came back and basically held 50% of the original breakout bar and then started up. So you got your retest here. The cloud picks up that retest and gives you a positive signal. Go ahead.
Okay. Since the markets are going to be opening soon, I just want to again emphasize, if you were looking for the ideal trading strategy that would cover everything, we're looking at the price for bullish. The price would be above the cloud. The purple moving at the line would be above the green line. The lagger would be above the price action, which means the dot would be green. The future cloud would be in the same direction, which is what the dots down here show you. Or you could just move it forward. But for me, if you're moving it forward, you still have to count. This shows you where it was in advance. So you would look to see if you had confirmation with the little dots on the bottom study. The price not too far from the these lines. In other words, this starts to get iffy as a place of entry because there's a big distance between these two averages. And what happened was, of course, it crossed here, and then you know, the entry points are best when these are fairly close to each other. So that would be a category. And when you're using the purple line or the green line, the lagger, it should not be in a thick cloud. So again, you want to make sure that these things don't occur in a thick cloud here. And then the last one would be that it closed above the equilibrium. Now, you're not going to get all of those to line up at the same time all that often, but that's what the green and the red histogram at the bottom tells you. When you do get this and it's extended, then hey, this is a really good trade. Yeah, we actually turned to the point where we had one even short, but you know, in a long trend, you're going to get mid-course corrections. This easily identifies a mid-course correction. And you'll notice that on some of these there are no dots, and that means that at that point in the future, there's no cloud. The two lines are right on top of each other. And that gives you no dots on top. It's not that it's not calculating correctly. Then it takes off again, reestablishes the cloud in advance, and it keeps going. You're not going to get all of these to line up all the time, but we can do another session where we focus not on the indicators themselves, but trading strategies and how they are used, the type of confirmation, the type of stops that you can use, some suggestions. And this is mainly on, these are all basically on trend following. There are other things, and you can see what they are. If you play that coming back to the green line in shorter time frames, and we can put that back in, then you can also see that this, you know, you can put this in on a 5-minute chart. Or any time frame that you're looking for. Here's a 15-minute chart, and it's pretty clear that you can get some pretty good indicators here. Now here's where you notice where it broke out, but these two lines didn't separate for a while, which means the midpoints were right on top of each other whether you were looking 9 or 21. That means we're obviously coming out of a flat area where no matter what your time frame is, the midpoint was the same. And then we started to separate. And again, you start to look at these things. We have the arrow and we have the cloud turning blue, well, the indicator's green. I made it blue. And you have the green dots on top. Now you're starting to get multiple indicators on a 15-minute chart. You can also see that we had all but one of these things. And again, which one was missing? These two were on top of each other. Otherwise, you would have been all green, all this area. But again, you can see that immediately you can see when they start to erode. Whether they're going to continue and it's a mid-course correction, you had a nice move here. This was clearly in history a mid-course correction, but you can see that it also eroded here and then strengthened again. So depending on your risk, this is on a 15-minute chart. This isn't a bad trade. And you could say put on some multiple lots, get out when this thing went below the purple line. You could get out when it went below the green line. When it went back, you could add to the position. It all depends on your trading strategy. So this is why I say this is a tool. It's not a trade system, but it's a tool. And you can mold it to how you normally trade. But the point being is it doesn't know that it's a 15-minute chart. So,
It's such a great visual. Look at it on the hourly. Go back to the hourly. I mean, it's a great visual on the hourly.
But you want it, if you want the stronger one, you still want it to agree with the daily.
Yeah.
Or the 240 in the daily. The daily being the trend, then your 240 would be your trade, and then your entry exit would be your hourly. The concept of a multiple time frame. And this clearly would keep you out of here. Well, you did have everything, but it never turned red for one bar over here. But once it went through the cloud, notice here, it went through the cloud. If you would have got out here completely and gone long here or gone short here, it would have gone right back through. But it was when it starts going above and below, you're looking at a sideways market. Now it's hard to trade these when it breaks out on a very long bar. Then you have an issue, because by the time you get all your signals and your ducks in order, it's already made a big move. But again, look at the cloud. The cloud was still bullish. It doesn't support a short trade at this point because the cloud's still going up.
And that's why you take this and you match it up with your matrix levels, you match it up with the macro trend, and then you extend your time frame and you go look at a daily, a weekly, a monthly, a yearly, and take a look and see if the 60-minute was anything but an aberration.
And keep a short stop. Then you're looking at the purple line or the green line as a stop because you know your counter trend. Not supported by the daily or the weekly or even the 240. By the way, just as an interesting thing, CQG at least will restart, no matter what your trade type, will restart when when a new session starts. I created a custom study which uses 1380-minute charts, and what that is one trading day built on intraday data that does not split or divide or separate the sessions. Some people didn't like the fact that you have a session starting at 9:30 in the stock market, an ending at 4:15 actually, and then another one. When you're using untimed chart types like constant volume bars or Renko bars, by using 1380, you wouldn't have that split at the beginning of each session, which is why there's a button up here for 1380. Just to let you know, just as a kind of a way of getting around that, but including all your trading. We can do another session in the future, if you like, looking at trading strategies rather than at definitions, and getting comfortable with what the cloud is telling us every day.
Well, Stan, this is hugely informative, and just the capabilities that are within CQG that no other trading platform has. You can't get these spread bars. You can't get these relationship bars that, you know, currencies versus gold. You can't get that even on a Bloomberg. You can't pull them up. They're line charts, you know, and here you have the capability of either pulling it up as a candle, a regular bar, a Heiken Ashi, whatever you like. Plus you can overlay cloud stuff onto it, and you can overlay multiple indicators on your charts. You can't do this with any other platform. And that's why Ira and I have been using this thing since its inception.
40-year anniversary this year.
All right. Any other questions, guys? And then we'll wrap this up and go on with our trading day.
Thank you, Stan.
You're welcome, and good trading.